Well, thanks very much for having me, Mark, and also Finola from RaaS. So yes, Trent Lund, CEO of Wrkr. Let me just run through quickly. I think for some who might be new to Wrkr, quick profile, obviously, trading around 38 million market cap. Myself as the director, I'm also one of the largest shareholders, along with the CTO, holding around about 40% of the company. So it's fairly tightly held business. Karen Gilmore, our CFO, and quite a diverse board. In particular, Emma Dobson, as our chair, was one of the original players from Westpac that helped create some of the very standards that drive the compliance in our sector. So I'll get to that as we move. So Sydney-based, but our people increasingly, to get the best tech talent, a little bit wider afield. Some guidance we've put forward, and I'll just highlight it right up front. This year, expecting revenues between the 9 and 10 million, which has been about a 40% year-on-year growth, a little higher actually in some of the early years since the merge and the creation of the Wrkr brand, and expecting EBITDA positive in FY25 is the current guidance. Before I get into the details, I'll kick off a brief video because I find for any new investors that might just explain the business in the simplest terms possible.
Wrkr is revolutionising workforce compliance by making things simple for both the employer and the employee. Not only does Wrkr digitise the process from start to finish via online dashboards and mobile applications in real time, it also completes verification of their information to ensure it's accurate with the likes of the ATO and other statutory and regulatory bodies. Wrkr helps capture data easily and efficiently, which removes errors and makes verification simple, from tax file numbers, personal bank details, and even super. Compliance is complicated, but Wrkr makes it simple by onboarding employees with accuracy to ensure correct pay, super and tax, while simultaneously submitting all the required regulatory information to the government. Wrkr have compliance covered from hire to retire. Existing HR and payroll processes are slow, manual and inaccurate. Constant errors cost time, money and are a cybersecurity risk. Wrkr allows you to check 3 key things: the right to work and identity, industry regulations, internal policy and certification. Wrkr ensures you have continued compliance by starting with correct onboarding, then monitoring your compliance daily, monthly and annually, providing real-time alerts to both the employer and the employee when things are due for renewal. Wrkr puts the power of information gathering in the hands of the employee. This allows Wrkr to do all the heavy lifting for compliance in the background. The Wrkr platform constantly monitors, checks and verifies pay and statutory requirements for every role within the business. Each time Wrkr submits a compliance check or verification for each employee, Wrkr earns a fee. This is how Wrkr generates revenue through software as a service and creates value for its shareholders. There are several critical moments in processing an employee's pay, from the ATO, super contributions, and even ABS reporting. Messages are sent via Wrkr in the background, whilst providing a single interface for the employer. Each time Wrkr sends a message along the payment cycle, they earn a fee. This is how Wrkr generates revenue through transactions and creates value for its shareholders. The Wrkr platform has a broad range of unique technology and licensing that underpins its easy-to-use interface for customers. Wrkr has done all the hard work, so the employer doesn't have to. It's compliance done simple.
So there you go. So look, before I jump into the performance financials, key in that overview is really Wrkr is building off the base of superannuation contributions and payments. That's really the cornerstone of our business. It's the most regulated element of Australia. There are only 10 companies with a gateway license and able to clear those funds into superannuation from the employer via their payroll into superannuation players or SMSFs, and we are one of those. And so Wrkr has built off the back of that cornerstone. We have continued to grow the compliance moments and leverage that high degree of confidence to be able to continue to grow and expand. In particular, two sides of the coin, and you would have seen it in the brief video explainer, but onboarding employees effectively and ensuring that all the right data is captured up front, because every error actually creates an enormous amount of rework and cost to employers and the super system itself actually down the track. And also the other side of the coin, which is making sure that every one of those payments is done correctly and in a very secure fashion. And that's an area we've focused a huge amount of our investment on. So very much these are regulated compliance moments. So we work with, we either go direct into the market, but in particular we work with the large super funds and their contributions platforms, or with payroll and HR software providers to do that last mile of payments and do those very niche compliance pieces. We very much get around SaaS, software as a service income, including transaction revenues that go along with that. And a great deal of our business growth has been shifting from original license and high services contracts to really more of a SaaS-based business. What is great about being in this business, these are the little moments that are not well known or understood. They're costly to put the infrastructure in place, but typically people don't make rash decisions or changes, so the contract terms and life cycle are long. So if I kind of jump into, so what does that mean, and you know, for the opportunity that is Wrkr. The Australian market alone is enormous. We are working from a base already today of 500,000, so 500,000 direct employees that we service their pay data, onboarding moments, and other compliance moments. We have our software as a footprint in 6 of the top 12 funds in Australia, and we meet over 20 high-value compliance moments, from onboarding as niche as medical license checks on a daily basis with APRA, through to each of those single-touch payroll regulated moments. Our current ARPU for our direct customers already sits at around $8 and continues to grow as we bring on more compliance moments. That's $8 per annum. What is really key and what underpins our forward growth in the business, obviously I say recent contracts, but they've been years in the works, and with Link Group, which opens up access to a growth potential of another 7 million potential users for us through their client base. And already we are now in implementation phase and doing the detailed live pilots with customers for REST, one of their larger funds, about 1.4 million active employees, so near tripling of what our current business looks like today. And actually, in parallel with that, live into Hong Kong already, so expanding our geography. The market itself is enormous. I'll leave the numbers for people to read later, but just to give a bit of a sense of what sits in front of us. There's about 13.1 million Australians in job. There's about 17.4 million jobs. Many people have multiple or work part-time. 13.1 million full-time employees. There's about 3 million just under hiring events, onboarding events every year. And from a pay perspective, there's about 500 million pay events every year. So people being paid, which requires money to be moved, requires messaging to be sent to the ATO under single touch payroll regulation, and about 160 million super contributions that are processed every year. And with new regulation coming in 2026, this is expected to match payday super as the regulation, where super contributions will happen the same day as pay, which means that market itself will grow some 68% up to 500 million contributions. So Clearly, company with the biggest footprint and the highest volume is the net winner in that game from a super perspective, but also well positioned to take on growth in the pay transactions. So that's really the core market and opportunity that is Wrkr. That's evident really in our financial trends. So let me share just a little bit of the background journey of where we've been through. So from FY20 to FY23, as you can see from the chart, we have had probably two elements that are really clear and stand out. Our revenue has grown successively each year, and it's important to note that much of this revenue, and particularly revenue of 23 and this year, FY24, has been an additional of that revenue has been services revenue as a precursor for platform licenses. Our implementation fees are considerably lower than the full production license fees at around $8 ARPU, average revenue per user, times, at 1 million users, obviously, that's a much larger SaaS revenue, and that SaaS revenue is an annual basis. And obviously, the super portion of that expected to double or triple over that period of time. So you can see we've been continuously growing on the revenue line. At the same time, very conscious of putting our business into a very healthy position moving forward. Our cost to income ratio has come down. So our costs do not scale in a linear fashion to our revenue. In fact, outside of our services, but where we are operating our SaaS revenues, as expected in the SaaS market, we operate at around about an 80% gross margin. So scale is really the friend for our business, and we are at the cusp of that scale now. So as you can see, hence why the guidance that EBITDA positive expected in FY25. That said, there are some significant growth opportunities in front of us. We've been doing this one fund at a time. The extensive work contracting with Lund that we've announced on a couple of occasions really positions us for a larger growth pool and trajectory than that. Highlights from our quarterly, important to note, revenue in terms of at the half two, so the unaudited accounts, but we don't expect to see a significant change in any way. So at half two FY24, on a year-on-year basis, we've had revenue 3.9 million, up 44% on the same half the prior before. Cash receipts from customers up 43%, and our cost to income ratio, I mentioned, just continues to improve. Obviously, we expect that to be a dramatic improvement as we onboard some of these new customer contracts. So, a great element, the business is growing financially and moving ourselves into the position of funding our own path forward. From an investment thesis, let me give a bit of detail. So why am I bullish and excited by where we've grown the business to? Couple of elements. Really strong contracted base. So I mentioned 500,000 direct users, but we have a footprint already in 6 of the 12 largest funds. So we have already been through procurement and security testing and are trusted in the space that we play. So there is opportunity for us to grow in our existing base. The Link Group Australia contract enables us to set a price and builds out a core base platform for us to take our software to each of their major funds. The first we're already in active pilot with REST, but some of those funds include the biggest in Australia, from Australian Super, REST, Host, Cbus, and a handful of others, smaller funds. So that contract really positions us to continue to grow and move ourselves forward. Strong financial management This team in place is a team capable of leading a $500 million business. We've hired really top talent, and so we watch every investment decision, and we are managing our opportunities very wisely. So cost to income is a really good indication of that, but also the quality of our engineering talent. We continue to set a standard in the work that we do, without doing that by throwing unnecessary costs. So we're a very lean engineering team. When you consider we're live footprints across some of Australia's largest super funds, and now in Hong Kong as well, with 42 staff. Importantly, I mentioned market-leading tech, but our technology is already installed and well trusted across both federal and state government, some of the leading super funds, which talks to the quality of the tech. We've made a major investment in the last 12 months around cyber and controls. We will announce and demonstrate more of that into the market, but we have been working with a large Israel-based cybersecurity company, Transmit Security, moving into a new model for security, which is effectively, for those who are technical and interested, think of a future of effectively passwordless security. So we have, for every individual that connects with us, we have a level of information that allows us to be, rather than set just binary rules, we can be dynamic about our level of trust with that individual and their credentials and their ability to make decisions or access information on the platform. Everything from the geo coordinates they come from and the operating system they're on, to the ability to challenge in real time and understand whether they are in fact the real user before making, say, a rollover decision of funds out of their super fund. So that is very much game-changing across the HRM landscape, payroll landscape, as most of the technologies have been well developed some time ago, and this is very much in the modern cloud tech era. On an outside of our business perspective, things which excite me, regulatory tailwinds are very much in our favour. I mentioned payday super. The bulk of our income, the bulk of our growth comes from working with processing that contribution. So every time an individual receives their super, we clear the money and move the money under our AFSL to the super fund. We send the appropriate messaging on the SuperStream government ATO network and through the GNGB Global Australian gateways, and we also process messages on behalf of the super fund back to the ATO. That is about 160 million contributions a year, that market today. 2026, with payday super reforms expected, that super contribution will no longer be done quarterly with BAS statements. It will need to be done at the moment of pay. That moves it from 160 million to 500 million. So we're excited about that because our install base grows dramatically, our income line without any additional software requirements for our business. On top of that, favourable market conditions. Everybody talks about interest rates. Interest rates are up. That's not a negative for our business, obviously, because we provide direct debit and manage funds through with a 3-day clearing. We earn, even off our small base today of 500,000 users, we earn about $1.8 million a year in float, and that continues in line as we grow our numbers. So on top of that, population growth is higher than expectation, and the government is really opening the gates on immigration to bring back more of the low-end jobs. Again, this is more hiring moments, more onboarding moments. So that growth is important for our business organically. The final element is industry dynamics. We provide software. What is difficult What's good for us when we have embedded software is it's unlikely for people to change it or make a change for change's sake. It's a large impost or cost. We have two main drivers right now in the market, or three drivers that are creating a business decision where they have to make a change. Number one is that there's an enormous amount of M&A activity across the superannuation industry, which is forcing them to make large core systems, which is obviously a great opening and entry point for us, which has driven our growth to date. Super funds are under greater scrutiny publicly under the APRA reports. So from that perspective, they are looking to work with lean operators such as ourselves. Really, though, the most important is with payday super coming, that is creating a moment for HR, payroll, and super funds to need to take the opportunity to create different infrastructure that processes a much higher volume of transactions and reduces the error rate. There are many case study examples of people super sitting in the ether for 12 months, as long as 2 years, being cycled around in a system because data is in error. That takes hours of cleaning and labour time, which far exceeds the value of the interest rate rise on those transactions. So super funds, particularly those that see around a 5% error rate of data, are really looking for new providers, and that's something that we score very highly on. That really is a summary from our perspective of Wrkr has, if I keep it really simple, we've gone through a period of two companies merging, cleaning and improving the business, building a brand that has now high trust and confidence. We've now developed the core contracts that position us for growth and the underlying financials. And really, this is now about managing the business into that growth phase and taking advantage of all of the hard work that's been done. That is the core of our business. So with that, I'll kind of give an opportunity for any questions that you may have.
Thanks, Trent. And before I kick off with questions, I'll just quickly mention I put in the chat the latest RaaS research report for Wrkr. So please feel free to download that at your leisure. Question, and I think it's a pertinent one, given the size of the SMSF sector, let's call it a third of the assets within the whole super system sitting inside an SMSF vehicle. The ability to send super contributions into an SMSF, is that, something, where Wrkr is involved in or potentially could be involved in?
Yes. Great question. 100%. We already today have about 24,000 customers. We've been running that product. We built it, so less than 18 months old in that market. And so we both process the contributions into a self-managed super fund on behalf of the employer processing. We also provide aggregated contribution management reports for the audit process and manage the rollover process by creating a unique electronic service address for self-managed super funds. So very much, while a smaller part of our business, we move very quickly with that tech, and that's been a fairly organic take-up to around about a $39 per year application. If bought direct, we're seeing a lot of growth in the small accounting firms in those areas. I think there's about 600,000 super funds, self-managed super accounts shared by about 1 million people. We estimate if you take the top 200,000 are in retirement or family office structuring, leaves a market of about 400,000. We think there is an enormous opportunity in that space.
Okay. And then one, in terms of we've got the half year results, as you touched on there, just seasonality within the business, Trent, with year-end bonuses and stuff coming in December or June. In terms of this business, is there any seasonality, or should it just be, what happens in one half, kind of happens again in the second half? There's not a regulatory process that happens for a lot of your customers that, skews the messaging and transactions in one half versus the other.
Yeah, no, we're bonuses. What do they mark? We're very fortunate. The cycling, every compliance moment that we deal with is consistent, throughout the year, and our licensing structure, where we provide software as a service, is very much on a pay quarterly annualized fee basis. So even though the transactions might spike, say in retail pre-Christmas with more hiring events, we don't tend to, it doesn't impact our income stream. So we're lucky. There's no real seasonality. The only thing I would say is we typically have a high spike in services as a precursor to onboarding a customer to be able to then reap the value of those transactions being much higher margin for us. The services we do at a profit, so it runs about a 30% engagement margin, but we tend to be, that is a precursor, and those projects can be a little lumpier. We're pretty good view of what comes about 6 months ahead, 8 months ahead. Beyond that, there is a level of lumpiness. We see that disappearing over the next 12 months. So as we have more SaaS and transactions revenue than any services revenue in the business.
And then I just want to quickly touch on customer concentration risk, because you named some of the biggest super funds there, and there's even merging happening between even the biggest funds. I mean, ART, if we just take them, as you say, as a direct customer who have gone from being Sun Super to merging with Q Super to, I can't remember the latest one they merged to create ART, but it's gone from 3 substantial funds in their own right into one. Touch on that, customer concentration risk in terms of ART and Australian Super getting together, and you're not the preferred provider for Australian Super, and they're kind of dictating the post-merger decisions.
Yeah, we're look, two parts. It's a real challenge when you've got merger and acquisition going. Decisions get made, and you want to make sure you're on the good side of it. We've been fortunate in that we were Sun Super, and our technology has prevailed in the Sun Super merger with Q Super, which is it's the most significant of their volume. We care more about volume of members, of active members, than the size of the fund from a financial perspective. I make the same money whether you work in a coffee shop or whether you're an ASX CEO on your super contribution. It's the same 20 cents worth of messages. So for us, we were on the good side of that, and that will pay out for us out into the future. Where we sit and where our footprint is now, we're not expecting much more consolidation at that top end of town. They have reached a level of scale. There is more now mopping up of perhaps some of the smaller funds. So from that perspective, we're fairly safe. The other thing is we've diversified our business, where we have a large portion from direct employers, and then we're now breaking out from really starting with only one major fund in Sun Super to having a much wider footprint. So our concentration risk will land at, if I play forward 12 months, we would be expecting, if we hold any more than 10% or 15% of our revenue in any one entity, the contract terms are significant, meaning they lock us in for a lengthy period. So over the next 5 to 6 year horizon, concentration risk won't need to be dealt with, but it's something good CEOs always keep an eye on.
Okay, Trent, we'll leave it there. Thank you very much for coming back and giving us an update on all things Wrkr.